Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited to be here today with Mike Bell and Justin Gingerich of Honigman. Mike, I've had you on the podcast twice before. Justin, you're new to the show. Guys, I'm excited to talk about bank acquisitions, branch acquisitions, all sorts of acquisitions in the credit union arena today. How you guys doing?
Very good, thank you. We're ready to talk about the same.
Very good. And for if you want to give a little bit of your background, Mike, we were chatting pre-show. I thought I had you on last year, but it went back to 2024. This is your third time on the show. But for people who might not know who you are and what you do at Honigman, if you could kind of give your bios, if you would.
Yeah, Mark, happy to. So, look, we're lawyers and we work at a law firm first to start. But in that space, we really only represent credit unions, never represent a bank, and are known in the space for first and foremost helping credit unions acquire banks. We did the first ever, and when I say we, Mark, that's you included, my friend. You were the regional director a couple years ago.
A couple years ago, yes.
Yeah, back when our hair wasn't gray, and we did the first ever credit union bank buy together. And since that time, we've done 100 of those and bank branch buys, other business buys. And then we'll talk today, hopefully, a little bit about the latest and greatest with the credit union to credit union mergers. But when I say latest and greatest, I mean big credit union to big credit union, merger of equal type things that have really transformed the space in the last couple of years. And then I'll kick it to my partner, Justin, who we've been connected at the hip for about 10 years, and Justin and I do these all together, and I'll let him add.
Yeah, absolutely. No, thanks, Mike and Mark. Happy to happy to join. But yeah, as Mike said, we're connected to the hip, or as I like to say, we're two arms of the same body, right? So the two of us together, right, are kind of creating and architecting these with between ourselves, our clients, right, but then also kind of the remainder of our team. And so my role and function here is kind of making these things actually come to life, right? So once we get sort of parties that are interested and get through sort of LOI stage, right? Somebody's got to kind of boil that down to paper, and that paper ultimately getting signed. And so that's kind of my role and function of working through with sort of the management team, executive teams, and making those come to life and being completed, if you will. And then it kicks over to the regulatory process, which we all know and love.
Very good. Yeah, the way you framed how you guys work together reminded me what I used to say when I was executive director. John Cutchy, the current regional director and in the Eastern region, was my deputy. And we'd brief each other in the morning, we'd brief each other in the afternoon, and we could finish each other's sentences if we needed to. So it sounds like that's the work approach you guys have to this. So what's the politically, volume wise, let's just kind of start about banks into credit unions. What's the state of affairs as we chat here in July of 2026?
Yeah, Mark, happy to. The known headline is that there have only been, I think, 4 or 5 announcements so far in 26. And so everybody looking at that would think, oh boy, these are down. There must be a reason. What's going on? And I will admit that, one, that's accurate. There have only been so many announcements. I'll tell you, I think there's one key reason why, and then I'll tell you what's coming. So on the reason why category, I have always said, and it's always been the case since the beginning of these, that credit unions are unsuccessful more than they're successful when it comes to being the winning bidder. And you'll never know that because it never is reported like so-and-so bid and lost, right? We only report the wins. That's just how the industry works. I'll tell you, this year, there has been plenty of activity, plenty of opportunities, and plenty of great credit unions making great bids. That's not the problem. The problem is the banks are as active as they've ever been, and they're bidding higher than they've ever been. And we're losing. And we're losing more than we've lost in the past. I don't view this as bad, Mark. I view it actually as proof that half of what the ICBA says is absolutely untrue. This year is Exhibit A to show that their claims about unfair competition and different things is completely false, right? So I can think of maybe almost 10 instances in the last 3 or 4 months where we have had a great client, a proven buyer with a great bid that got second place, okay? Now, I'll tell you, I think that certainly continues, like that hasn't disappeared, but because of the activity levels, because of the volume that we're seeing, we have some wins coming. So Justin and I have a short list here that, it's not public yet, but absolutely before the year is out, more of these are going to be announced. We're very close on a couple. There's more activity on more. So I do think this year ends with far more than had been announced to date, but there's absolutely reasons why these things are less than normal this year. And it's because the banks are aggressive.
Got it. Justin, any thoughts on what Mike said there?
No, I think it's 100% right. And I think just the emphasis is worth driving home again, is that we've historically lost a lot, and we're just historically, we're actually losing at a higher rate than the historical norm at this point. Right. And so, for those, kind of anti-competitive, types of claims, or, hey, credit unions are always able to pay more, or they're paying more premium than they ever should. If that were true, we're now losing significantly more than what we previously have. And so the free market, right, that we always advocate for, must be working in the right way in order for that to happen.
Yeah, and the free market working too. It's like, okay, so this is good for banks, right? Because credit unions have got into the market. It's like when you have three people bidding on a house, right? You get a little bit more concerned that you might not win, so you put an escalator in and you get it. That's good for the seller. And in this instance, it's good for the sellers of banks. So credit unions getting into the game has made the sale price of banks in total higher than it would have been if credit unions weren't in the game.
Yeah, Mark, that is 100% correct. It's what we've been saying. It's what all professionals in the space say, not just us, but the guys that sell these banks say it. And you can look in the states where these are prohibited or curtailed, the very few, by the way, and you will see the pricing is lower. If you dig in, you're going to see that banks in Tennessee are worth less. And Tennessee is a great economic state that we always hear about, right? It's on par with Florida, where I live, and where you spend time in your camper, right? But the banks in Tennessee are worth less because of the law they passed. The banks in Washington State are now worthless because of the law they passed. In other states like Illinois, where there's a lot of activity, I can just think of, a few instances this year where we've had amazing, strong bids and the banks have sold for far more than they expected due to an aggressive bank bidder. Good for the state, good for them, right? Good for the free public there.
That's right. And the Washington State, that's a whole new, that all started and became a law, I think, since we last chatted. So what has that done in Washington, if anything you can tell? I guess if there aren't any happening, it's curtailed banks, credit union from bidding, which is impacting the price.
Yeah, it is. And I'll tell you, I think reasonable minds prevail there, and that law eventually changes. That law was interesting, Mark, in that it was a tax law. They were trying to find revenue, from what I understand. They thought, all right, well, if a bank buys it, or a credit union buys a bank, we'll expose them to this tax, right? Well, no credit union is going to agree to do that. So far, that tax bill has raised $0 of revenue. And I'm going to predict that not one penny will ever be paid of that tax. And what it has done indirectly, or perhaps an unintended consequence, is it's shut down the market of credit unions bidding on Washington State banks, and the value of those banks has dropped. And we all know from the business we're in, there are some amazing, strong, great credit unions in Washington State. Always have been. It's a great, strong credit union state. We have great clients there. And what we're helping them do today is merge with other credit unions, is look at acquiring things that are not banks in Washington, look at requiring institutions that are outside the state of Washington. Like, we're finding the pressure of wanting to grow. We're finding the pathways because they shut one down. But boy, it would be a lot easier and cleaner once they undo that bad tax law, which I think they eventually do. It's raised zero revenue, and it never will.
Yeah, I remember hearing some of the politics behind it and how it got approved, which was like politics, I guess.
Yeah, last minute political things.
Right?
It'll be it.
Yeah, so be it. So be it. Last time we chatted, we talked about, and you mentioned a little bit, there's other acquisitions other than bank into credit unions. There's branch deals. There's title insurance companies. There's lenders that get acquired that become parts of CUSOs and things. What's going on in any or all of those these days?
Yeah, so on the branch side, the space remains active, and each year, we help more credit unions buy bank branches than anybody else year over year, and we'll keep doing that. We have some great branch buying clients that really specialize in that and have had massive success. A lot of those I'm seeing are in the Southeast or in the upper Midwest. I think that's random. I don't necessarily give you a scientific reason, but those opportunities keep coming and we keep, we're one of the best buyers for those things. So I view that as absolutely an area of continuing focus. Really, I think always will be. I will point out, though, for first time viewers or considerers of this, in case you haven't heard either of us talk before, I think people need to understand that a branch deal will never happen on the big end of the spectrum. Chase, Wells, Bank of America, they never sell a branch and they never will. Nor will it happen on the very, very bottom where we have like a 3-branch community bank. Either end of that pendulum, you'll never see it. So if you call me up and say, hey, there's this Wells branch I love, I'll say, sorry. Like it will never happen. However, if there is a larger community bank, regional bank, or small regional bank, that's the sweet spot. Those are the kind of banks that sell branches, that have a reason to sell them, that benefit from selling them. And they're actually the kind of branches we want to buy. They're the best for us, the way the business is done there. So it's just something for folks to keep in mind. And then I will add, these other businesses, it's rather endless, whether it's investments, insurance, title insurance, real estate related. We kind of do those all the time and can really almost compromise anything. Credit unions between themselves and their CUSO powers, I think, can virtually get into any business they want to, or they should. Let's be clear. I don't think we're going to own junkyards, but why would we? But anything financial adjacent or financial related, I think that credit unions have the power to be in that business and do. And then one thing, Mark, I'm going to tee up for Justin, and I'll tell you, I think is, I would say, new. We have recently worked with some of our larger credit union clients, kind of the upper echelon of size, and we have helped them actually acquire kind of current or existing CUSOs. So there's a bazillion CUSOs out there and they do great work, but we are seeing a trend now where some of our bigger clients are going to buy and bring those things in-house, which is interesting. Justin, I'll let you chime in on that, Con.
Yeah. And so, yeah, it's a really good segue. And I think at the end of it, right, and for those of us that have, or for those of you that have heard myself or Mike speak on this, right, I mean, we view this as sort of the non-organic growth aspect, right? And non-organic growth is really triggered by not some of the detractors, right, would say, well, you're just growing for the sake of growing, right? And I think what we really focus on, and I think what we see a lot of our clients focus on, is they're really growing in the name of member service, right? What other features, what other functions can we provide to our membership to kind of make that relationship stickier? And what you find, and this is kind of where the CUSO to CUSO trading, if you will, is going on, is that there is a lot of discussion on buy versus build, right? A lot of these larger institutions are could they go out and start sort of their own insurance, CUSO and build that out? Absolutely. But another organization, or as we've seen the trend become, a collection of organizations have basically, funded or founded some sort of CUSO, and they're looking to basically sort of trade that off. That becomes sort of an opportunity or a springboard, right, for a larger institution to just say, look, let's just buy this and in the name of member service and member stickiness, versus, having the investment, which at the end of the day is going to be slower, probably more expensive, more rigorous from, a regulatory perspective. Let somebody else who's already gone through all the hassles of building and getting approval and, the learning curve, that tuition, right, is already paid. Go out then and just acquire that on sort of the secondary market. And that's a trend that we're seeing sort of more and more. And what's fascinating now is I think a lot of those early investments between multiple institutions into a particular CUSO are now sort of getting to maturity stage, right? Where the institutions are kind of looking and saying, like, look, we've held this for 3 or 5 years. Now it's maybe time to, kind of move this off of our books or figure out a way to make this sort of bigger than what it is. By no means, right, do I want to call it sort of, a private equity-like model, right? These institutions are not thinking in the private equity way, but some of these CUSO conglomerates, right, or cooperatives, not to confuse it with the credit union mission, are kind of operating in that way, right? We made a collective investment. What do we now do with this? And larger institutions are probably a really good acquirer of those, especially in the name of member service.
Yeah, and if you've got a structure with a good office space, a good board, good policies, good procedures, clean books, and you've already got that regulatory approval and you kind of peaked, right? You've had your growth and maybe you've stabilized. Maybe it's this bigger institution or a conglomerate of bigger institutions that can say, hey, bigger credit unions that can go, okay, they got it to here. We can make it bigger. We can utilize this. It adds these couple of services we don't have. And then it solves that piercing the corporate veil thing too, right? Because it came from clearly is different because you acquired it over here and you didn't form it over here with the same exact board and people. So I could see that as a big positive. I hadn't thought of that as an area of growth for acquisitions, but it makes sense.
Yeah, and Mark, I think it's because we didn't chat last year because I think it just started.
And there we go.
This is a 2025 thing, and literally last week I got a phone call from our friends at Olden Lane saying, "Hey, we have an idea. There's this CUSO. It's mature, right? Like," and their instinct in my comment was, "Hey, there are big credit unions out there now acquiring these things," and so a lot of times, Justin mentioned a lot of the reasons. I'll add another. There's a lot of times these CUSOs are beautiful. They're wonderful. Nothing's wrong, but their management is aging. Right. We're talking about this.
Yeah.
And so here we are. We need to now invest in the next big management group. Or is this the time maybe it's mature and we offload it? And a sophisticated credit union is they're saying, hey, we've spent a lot of time building an impressive management team that is deep. We want non-interest income, right? We want to amp things up at this place. Let's buy this thing, buy that thing. And it all kind of comes under this umbrella, and we need less maybe direct management because we now are in-house and the sophisticated team has the bandwidth and wherewithal to support it. So this is new, Mark. I think if we talk next year, this is something to kind of put a feather out there to say, hey, do more of these happen?
Yeah.
Is this continuing? Because we're seeing it on the front lines anyways.
Fascinating. So, if I want to buy a house or want to just monitor a market, I look at Redfin or I look at Realtor. If I want to buy concert tickets, I look at Ticketmaster or StubHub or SeatGeek. If I want to buy branch deals, if I want to buy title insurance companies, specialty lenders or CUSOs, where's obviously people know you do it, so they call and say, hey, I'm looking to sell or I'm looking to buy. How do those deals come together?
Yeah, so this is a fair question because I would not call this an efficient marketplace, right? There is not a StubHub, right? There is not a Zillow. But what there is, though, is a small world. So though it's not the most efficient marketplace, I will tell you that there's probably 20 people, 25 people that you would speak to that are in that market that are going to move either on the buy or the sell side, virtually everything that's out there. Are there exceptions? Sure. But really on one or two hands, if you talk to ourselves, various other folks in the business, you're going to figure out really quick what's out there and what's not, or you're going to learn who you need to speak to and where you need to put yourself so you're in the market and you're seeing deal flow. So maybe someday this gets efficient. I don't know how, though. It's more of a classic marketplace. I don't think there's a way to make it any more efficient than it is.
Sure. So said another way, if someone has a CUSO and they're listening or watching, and they think, hey, maybe I want to sell. Or if someone's saying, hey, we're thinking about getting into one, I'm in that bigger, define big, but I'm in that bigger arena. First place to start is to call you guys and say, hey, I'm interested in buying or I'm interested in selling, because it sounds like you're connected to a lot of these as this starts to grow.
Yeah, it's true. And I mean, this is not a sales pitch, because I'll tell you, we spend a majority of our time just talking to people and talking to people for free. Like, you don't sign engagement letters with us. You don't give us any of your money. We don't want it. You're spending most of the day talking to buyers and talking to possible sellers with no fees going anywhere and never going anywhere unless we actually do something. Yeah, that's just how this works. It's how it has to work, I think. I don't have a better model. And so there's a short list of people, right? Justin and I are on the phone all day long. I'm not going to name the names of the credit union buyers.
No, of course not.
But we're talking to the investment banks, whether it's Hovde or Olson Palmer or their Sandler, right? And we're also talking to what I would call credit union industry partners or vendors, Olden Lane, ALM First, Dorn Mayhew. we're spending our time, and there's just a small group of us that
Right.
kind of space discussing what's there, what's not, who's looking for this, who's looking for that. And that's how things come together. It really is. I'll give you an example. If you're a credit union in let's just say the Southeast, Florida, Georgia, Alabama, and you called us up and said, hey, we want to buy a bank or buy bank branches, I'm going to say to you, great, here's what we have today, right? I'll give you a listing of everything we're aware of. And here's the other two people. That's it that you should speak with, right? Between the three of us, you're going to see everything you need to see. I say the same thing. It'd be two different people, but in the upper Midwest or in the Northwest. It's very simple to distill down who's in the market and who's not, in my opinion.
Very good. So the credit union to credit union mergers. Let's chat about what you're seeing in that arena these days.
Yeah. So for the entirety of my credit union career, which has been about 23 years long, for 22 years, this did not occur or maybe occurred once. And that is kind of credit unions of significant size merging. We'll just call it merger of equals, or MOEs is the official term. However, starting a couple years ago and continuing to this very day, there is MOE activity that has never occurred in our industry, ever. We are, by the week, talking with credit unions all over the country that are in some piece of the timeline of an MOE. Now, look, to be clear, some of these are, hey, Mike, I just had coffee with so-and-so. We think it might make sense. What do you think? The very beginning. Some of these come to us and say, hey, you're not going to believe this. We have a signed LOI. We just put it together between the two of us. Here we go. Right. So that's on the other extreme end. If I get 10 phone calls about we just had coffee, maybe 2 or 3 of those come together, right? And there's a high failure rate, be clear. But I'll tell you, I never got phone calls about the we had coffee, or maybe once a year. Now I'm getting them every week, Mark. And then I would say, if we get the phone call about, hey, we have an LOI, I think 8 out of 10 of those get home and get done. There is not a high failure rate after that point, but I cannot emphasize enough the activity level. So I was in a room, the League of Southern Credit Unions, a great state league, by the way, one of our faves. I was at their CEO conference. I think there was 40 CEOs in the room. I think I could say to you, there's 30 of them that I'm in the middle of conversations with about something, which is just unheard of in the past. Now, I will tell you that they're complicated and they're difficult, but we've had more success than we've ever had before. And I'll kick it to Justin, just for an opinion about perhaps why we're having success with these things and we weren't in the past. Because to be clear, these things were like the black swan. Now I'm going to call them normal, which is a huge difference.
Yeah. And I think that normalization, right, just to kind of preview, I think why we're seeing the bigger trend and why, and if they get to LOI, right, kind of why they're coming to fruition at a higher rate. It's a lot of the things we've kind of talked about, right, in the, we just talked about it in the CUSO side, right? It's succession planning. It's difficult to run an institution of size efficiently. And so if you have sort of two $5 or $6 billion institutions, they both have extremely high technology costs. They have extremely high compliance costs. There's actually sort of economy of scale in combining those two institutions together. And if you get the side effect of, again, more member product, more member service, more member benefit, succession planning, and operational efficiency, those things really start to come together. But, as Mike was saying, from a black swan event, I think the reason that we've had success is actually a result of the regulatory team that we have here at Honigman, that Mike and I work with. Our partner, Brandy, is a savant, it feels like, right? And sort of navigating sort of this process. And this deal is public, right? So I feel fine to talk about it, but our firm was a part of the Wings and merger transaction. And that was one that was announced. It was one of kind of two that were going on about the same time, both going through the Western region. And it was, creating an institution, north of $10 billion. And that with it came a whole new regulatory landscape, right? It was a regulatory process that really never been done. Interestingly, it was going on, in two separate transactions at the same time in the region. But we were able, I think, very much so due to the efforts of obviously the internal teams, right, for both wings and end, but with Brandy to navigate sort of that regulatory process. And we got approval on that deal to merge in 4 to 5 months, right, which is unheard of. And so I think it really comes down to strategic planning, outside guidance, internal buy-in, right, having sort of the subject matter experts inside of the institution kind of sort of create the most efficient regulatory application possible. And that's something that, our team can kind of help guide with. But you're kind of at this point, especially with the large MOEs, you're baking a cake, but the recipe is only kind of half written, right? Because everybody is sort of catching up on this, right, from a regulatory perspective. And what do we need? How do we do it? Is that enough information? Is that too much information? And so it's a bit of building the plane while we're flying it. And that's something our team, I think, historically has been really good at. And obviously we've got clients who are able to kind of walk through that process. And we've got some of the best clients out there, right? So they take guidance and info really well. And we were able to have a successful outcome. And that was one of what I think will be quite a few, right, in the very near future.
The last exam I did as an examiner was Northwest Airlines, which was wings back in Minneapolis. Their CEO at the time was a guy named Fred Smith, who, when I walked into his office, he handed me his business card and it said, "What, you here again? Another half hour shot to hell." So he was a very cool guy in the history of wings. But, as you describe that, putting my regulator hat on, building it while you're flying, a lot of times I'll get asked, what's NCUA's position going to be on this, right? Because big into big, you get into, gosh, should NCUA care, right? And the reality is, if it meets the regulatory requirement and and your disclosures are great, it's the democratic process, and NCUA will honor the democratic process. And so all of the angst that someone might have about what's the regulator going to think, they want you to follow the rules. They want you to notify the members, and then the chips fall where the chips fall. That is how NCUA looks at it. Now, the other thing is, as you're developing this expertise on these bigger ones, this kind of goes into almost every conversation I'm having these days. NCUA is down about 30% of their staff, right? And the people they lost were the ones who were eligible to retire, close to eligible to retire. So they lost a lot of corporate knowledge, which makes it hard sometimes when you go in saying, hell, we've done 2 of these. So ironically, when you're doing some of these and the flow starts to increase, you're kind of educating NCUA a little bit too, because some of the people who might have approved some of them previously are gone, right? So it's this constant re-education of NCUA at this juncture right now too. So.
Yeah, absolutely true. And that's why there's like a new normal, and I don't think it's bad though, Mark. No, I think that everybody is finding their footing. I would say, as an outsider looking in, with the big changes in the staff production and everything, I feel much differently now than I did middle of last year, right? I feel like there's been a settling, there's been a calming.
That's good.
I feel like the agency, credit to Kyle Hopman, to be honest, has really tried to do better with what they have. And so new procedures, new guideposts, new whatever, these little things matter. And, is it perfect? No, none of us will ever say that. But is it better? I think it's a heck of a lot better now than it was a year ago.
People rise to the occasion, right? There's a lot of talented people at NCUA who are waiting for the opportunity for some retirements to happen. And so now it's kind of like an expansion baseball team, right? The backup catcher gets the opportunity to prove that he should be an everyday player. And that's what's happening at NCUA right now.
Yeah, true.
Another musical reference, you talk about the Black Swan event. I always think of a line from a Suzanne Vega song. It's a one-time thing. It just happens a lot. So that's kind of what we're starting to see there. Well, guys, the things I had written down to chat about, I've kind of checked the boxes here. Is there any other topic you wanted to discuss here today before we put a wrap on this?
Mark, no, but I would end just by saying what we already said, but let's make a short little list, right? And take the list.
Yep.
And that is, the bank acquisition thing remains alive, remains exceptionally active. I would encourage people to pay attention. And then the bank branch, other businesses, sure, But we identified two kind of newer things that I think people should not miss out on or not think about. That's this idea in the CUSO space of some mature CUSOs, some aging CUSOs being acquired by single credit unions. And then what we just talked about, the CU to CU merger thing. Now, I'm going to say this doesn't mean everybody should do it. I'm not saying if you're not having a conversation, you're wrong. But I would say that if you don't think this is happening, your eyes are closed, right? Everybody's talking to everybody. Again, not a reason to do it. It's just a reason to be aware of what's happening in your industry. And they're doing it at a level that it continues that I have never seen before. It's shockingly high.
Sticking your head in the sand is not a good strategy for the long term.
Correct.
So paying attention is important. Justin, any last thoughts?
Yeah, I think at the end of the day, right, I'll kind of close with the same thing I close every talk that I give, right, which is strategic non-organic growth will continue to be a driver of success for institutions that are looking for growth, right? It's never a playbook, right, for those that aren't interested in sort of, finding sort of that jumpstart to the balance sheet or to member services. But if you're sitting in boardrooms and strategic sessions, right, and as we know, a lot of our clients are getting ready for kind of that process, despite that we're sitting in July, right? But those meetings are being planned as 2027 strategy comes apart. If 2027 strategy says, look, how are we finding sort of more non-interest income, and how are we providing new members, or how are we providing new services to members, or how are we getting new members? Strategic non-organic growth is a really solid way to check a lot of those boxes on strategic plans.
Nice. That's a great wrap, guys. Well, Mike, Justin, thanks so much for your time, and listeners, watchers, I hope you'll do the same again soon. It's been a lot of fun, and we'll catch you next time. This is Mark Treichel signing off with flying colors.